Good morning, everybody. Good morning, Trend Following Trading Club members and visitors and guests. 4,000 members. What a great club to belong to. There's no dues. No, you don't even have to come to the meetings. Hardly none of our 4,000 members. Very few come. But it's so much fun to get together every Friday morning and chat about things. It can be trend following. It doesn't have to be, of course. The markets in general are been pretty favorable, I guess, to the trend followers these days. Short interest rates, short the bonds, pretty good trade, and commodities still doing well. So we got a lot of stuff we could talk about, a lot of good stuff on Twitter. Arthur got us started yesterday. He got me going yesterday on indexes, trend following, stock indexes, any kind of index. I'm against all of that, of course. And phase shifting, that's something that Richard brings up a lot. I'm going to have to mute myself because my wife is singing. Anyways, let's talk about indices. And one of the things that he brought up, was that smoothness. And we keep talking about how we don't really care for smoothness in our trading. We want these outliers. We want have a lot of trades on longs and shorts, lots of different markets. Hopefully we're in the midst, some of these trades are in the midst of being an outlier, and they're making us lots of money. They're very volatile. We need the volatility. And then, but someone tweets, indices are great because they're smooth. And I was like, whoa, no. We don't want smooth. We want to add all of our markets together, all of our longs and shorts, and we get some smoothness, even though individually, hopefully we don't have too much smoothness. We need some volatile outliers that are going to bring home the bacon and make all this money for us. Oh well, it's a never-ending topic. Um, all of us will never agree on, I'm sure. So, someone has their hand raised. Good morning, Richard.
Good morning, Jerry. I hope you can hear me. Look, it was a very interesting little discussion on Twitter. I got heavily involved in it. And look, it is packed with nuance, but, I tend to believe that the classic trend following methodology has a particular process it applies with its models that, the traditional notion that an index is a method to smooth price movements through consolidation. I think that's actually not in tune with what our models are picking up. And the way I'd say it, firstly, when we choose an index like the S&P 500 or whatever, the first thing to realize is that that is an index comprised by a committee of a cap-weighted index. So in our models, when we are trading equities, we trade many different equities. I don't at the moment, but I plan to. But for instance, you do, Jerry, and your models don't necessarily select the same equities as that committee has chosen in that index. So with the application of our models that are looking for a particular case in the market, the way our models work is it does its selection for us based on the signals produced by that price and how our models respond to that price. And we might get a large, broad array of different equities to trade, but it certainly is not going to be a cap-weighted index. And secondly, it's going to be an equal weighted index of a basket of equities that our models choose. And our models are choosing based on what I believe is asymmetry as opposed to smoothness. So this is where I jumped on the bandwagon again. I noticed your concern with the smoothness issue, and I sort of jumped in on it as well. But there is a lot of nuance in this. It's probably something that we can talk about further through this Clubhouse. But the principle resides in the fact that When you are consolidating return streams, each of those individual return streams has a component in it of noise, and it has a component in it of a signal. Now, because we are trading both long and short signals, when you get an index given to you by a committee, a lot of those signals that might have been both long and short, they when they are at the same phase of that return stream, what I'm saying there is that they destructively interfere with each other and they cancel out. So our models are particularly looking for either long or they're looking for short. They don't suffer from this destructive interference of signals through consolidation. I do agree that noise is reduced through consolidation, but we all know that through our process of developing our basket of trend following equities. But I don't believe that we're after a smooth price to trade. I think we're after the asymmetry that exists in that, the non-linearity that exists in that, so that the outcome of our models produces not a smooth equity curve, it produces what I refer to as a stepped up equity curve. And if you are looking pound for pound, what delivers the biggest compounded wealth over time with absolute returns, provided your equity curve is stepped up, that will achieve a better compounded return than a linear ascending equity curve. So that's where sort of my argument comes from. Obviously, it's packed with assumptions based on the models that we trade, but that's how I see it.
Hi to everyone. As always, we're happy to be here. I want to say that this idea of trading indexes, I think it's against our rules of diversification, our philosophy, not rules, our philosophy of diversification, and of course, when we do so, uh, we do something that is not suited to our philosophy, because it's better to have indexes, two, three stocks from each industry, and will give us a diversification benefit. And if we and I know this from Stop Traders Unplugged, from Systematic Investor, from Maritz, from Jerry, and from Niels. And when I have heard it from Niels, Maurice, and Jerry, I was very happy, because I understood that it's really very good idea to trade separately, to trade a component of the index, and we will have benefits, real benefits from it.
I think it's you. I have a feeling that you guys put it as a choice we have to make. We have to either trade the index or the individual stocks. But well, if you have to make this choice, definitely trading the individual stocks would be better, because you're just like Oleg said, you're exploiting the diversification of the components inside the index. You have more room to exploit it. You have to be either long or short different securities. But I see an argument in favor of the index, and that is, it has a life of its own. I don't see it simply as the aggregation of different stocks. And the reason behind is people trade the index not based on the individual stocks. We have a lot of people trading passively on S&P or on NASDAQ or whatever, individual traders, large allocators, and they trade options on top of it. They trade the hell out of the indexes. And many times you have some flow of assets, not because the individual stocks are moving one side or the other, but because the people are allocating money to these ETFs or these passive vehicles that prompt the stocks inside the index to move up or down in conjunction with the index. That's why I say that sometimes the index has a life of its own. And then I wrap up with the first question I posed is we don't have to choose between trading individual stocks or the index. We can trade both of them. Sure, you have to think you have to spend some time thinking about how you're going to weigh these things, because they definitely will be similar. It would be, I think, reckless to just treat them as completely independent. But we can choose them all. Each one of them has a life of its own. Each one of them has possibility to trend up or down, and we can put our systems to work on all of them.
I hear you, Bruno. The only thing I'd say to that is that if we're looking at the indexes out there that are available to trade, these cap-weighted indexes, for instance, I find that the bulk of the price movement is attributed to a handful of stocks. The remaining balance of that entire composition of that index is just contributing noise to that overall price movement of that index. Now, I don't know whether you guys have found the same as me, but when I apply my trend following models to commodities, to indexes, to Forex, to metals, I find that I've got to create a subclass for my indices because my models don't work the same way as they do for the other asset classes that I'm trading. They are a system unto their own. We recognise they're a system, but what I find there is that our argument of sample size gets compromised here, because as soon as you can't trade these things called indexes the same way as other asset classes, we lose sample size. So this is what I'm concerned about. Our premise or our philosophy is based on a principle of these outliers, unpredictable outliers. It's based on the principle of we are ambiguous to which liquid market we trade, because we are using a model that normalizes our approach across any liquid market data to effectively reduce the individual character of that market data and to exemplify the outliers that exist in that data. So we're just focusing on these outliers or these tail regions of the market distribution of returns. We're not investing our efforts towards trading characteristic patterns within individual markets or sectors. So I'm saying that a lot of approaches do that, and I'm saying convergent approaches do that, and yes, there is an edge to that. But I'm saying this is where we compromise our absolute returns by diluting it to produce these smoother equity curves by trading this other form of edge, this what I regard as a lesser form of edge that exists in the linearity of the mechanics of the price move, as opposed to this non-linear feature that we're targeting. That's just what I think.
And I would put it this way: think about the energy markets, or the oil and oil byproducts. You can understand oil as a basket of gasoline, gas oil, gasoline in Europe and whatever. And if you put some analysis on it, you can make it like, well, I see that all the price in WTI oil is explained by the price movement of gasoline and gas oil. So I'm not trading WTI because all the diversification I need is within these byproducts. And you can find another 3 or 4 byproducts that mostly explain the price movement of oil. But oil itself do have a life of its own as well, and we do trade all of them. So that's why I say that I don't see the reason why we have to make this choice. We don't have to. We can trade all of them. We can trade the individual stocks and the indices. Another metaphor that comes to mind is imagine a person walking a dog. If you don't understand anything about walking a dog, you will see the dog pulling the person, and you will think that the dog is leading the way. But that's not how it works. Actually, the way it works for anybody that's walked a dog, a big enough dog at least, is that sometimes the dog pulls you and sometimes you are pulling the dog. Now imagine the index as the person and the individual stocks as individual dogs that someone is walking. Sure, the if you're walking 10, 15, 20 dogs, chances are they're pulling you and you're not leading the way. But sometimes you can, I don't know, grab something and stop the dogs from moving or anything like that. All I'm saying is the indices do have a life of its own that sometimes can or can potentially have a different movement that we can exploit through our systems.
I would say on that obviously the indices have a chance, or they have outliers as well. I think what we are talking about here is not the fact that there couldn't be outliers or asymmetry there. It's just you're lowering the probability there, because when you have individual stocks, they obviously have the a life of their own. But when you obviously add them together, you summing it up. Basically, the outliers that you find in individual stocks, you dampen them because they are almost diluted with other stocks that might not have the outliers. So on a net to net basis, the you're dampening the asymmetry. So it's not the fact that you couldn't use obviously indices to get those, but you're reducing the chance of finding those outliers um, by having the sum of those, because obviously each one of them, there's a weight to it, so each one of them will almost impact the other one. Whereas when you look at individual stocks, obviously they have, it's a bit more raw, so they're less affected by obviously the other stocks around them. So you look, like you can do both, right? But if you really focusing on asymmetry and the outliers pure in a pure form sense, then obviously you want raw data rather than a sum of different datas, because obviously um, then you're reducing that.
That's how I see it, Jeff, too.
Richard, can I ask you a question? This is maybe thinking inside the box, but isn't there a statistical or numerical way to prove what we are saying, to prove that indexes at the end don't have the necessary outlierish behavior, so it would be better not to trade them?
Yeah, there is. It's a physics principle of amplification and destructive interference. So it's, if you go back to the physics class of looking at wave tanks and you look at superimposing waves, if you treat each return stream as a wave comprising noise and signal, physics principles definitely declare loud and clear that through consolidation, noise is reduced. And this is the same principle that sound engineers do in their headphones to reduce the noise in their headphones to increase the audio signal. The only question is, in an index where you've got the possibility to be both long and short for those different return streams, when you're down at the individual return stream level, as granular as you can get, you find that the signal is either long or short. But in an index, it can be both at the same time with different return streams. What that does is it actually cancels that non-linearity. So if you've got a big non-linear positive signal and a big non-linear negative signal at the same phase, when you're looking at the consolidation of these waves, they actually cancel each other out. So you actually lose some of that non-linearity you want when you are down at the finest granular level. And really, the principle holds when you come down to examine the performance of an individual business versus a sector. An individual business, unfortunately, doesn't have the chance to be successful and a failure at the same time. And so individual businesses, it's almost an ergodic thing here. Individual businesses express either or, they don't express both. And this is where the issue with consolidation into an index comes when you're seeking this asymmetry, this directional asymmetry. We're not looking at volatility here, we're looking at directional asymmetry. And the finest level of granularity you can get is the way to go. Now, mathematics talks about the square root law as a basic principle to reduce levels of noise, but it's really a deeper physics principle that you can see in a physics class.
I want to say that I accept two maybe ways of different indexes. Is the first way when you have, for example, 50 stocks, individual stocks, or maybe components of the index, and 51 will be indexed in the same weight. So 51 instrument, and one of them is index for bigger diversification. I don't think that we really need it very much, because maybe it's better to take exotic stocks, exotic stock one, exotic stock instead of this. It will be less correlated to other 50 stocks. So maybe it isn't the best way, but it's possible. I think so. And the next, it's my own thoughts, and I didn't maybe not hear this thought, and maybe it's not the best decision. But if we have a massive crisis like in 2020 or 2008, I think that it's acceptable for me personally to switch off my stocks that close all the trades. For example, I have 50 stocks, 50 stocks trades, and close all it, and open trade. It will be short, of course, index, because it's for my. I can see what happened, control this better, because I have one trade, not 50. Maybe it's not the best decision, but I think it's possible, because to switch off all this, to switch on index trade instead of this, because I traded, for example, components of that index before for better diversification. But when we have a crisis, all goes to zero, goes into the direction of the zero, so all goes to one. And maybe it's okay, and of course to reduce our risk. And I think this is like maybe for crisis, maybe it's okay. I don't know it exactly.
I I, I think by the very nature of what an index is, say this S&P 500, it's it's a horrible, very slow to move trend follower as itself. You know, if you have 501 companies, that 501st company that's knocking on the door of the S&P 500, by the time it becomes the 500th company and gets into the index, you know, Jerry and the rest of you guys, you know, it's already gone up, who knows, 1,000%, you know, because it and then the worst company, the 500th company, has already done horribly and is going to get kicked out of the index. So I don't see why you would want that.
And the entire system itself is a rotational system where there's a long bias created through its construction. Now, our models, we want to trade both long and short. So, you know, it's not surprising that we find that indexes don't perform well in a short environment, considering the way the index is constructed.
So that's exactly what happened in Tesla. It's another example of, it's a very poor trend following system. Let's just say it's poor because when I was long Tesla at the breakout a couple of years ago, you know, when did Tesla go? When was Tesla included? Like, was it a year or a year and a half after that? So Tesla, I think there was even news that it came in as the highest, the biggest weighting ever in an index. So it was, you know, darn late, you know, to I had made all this money in Tesla, and then I guess they have a committee. Do they even have rules? Do they follow these rules? But they're bad rules, you know. They're inconsistent rules. They're not the type of robust signal that we get: buy the 100-day high, sell the 100-day low. No, it's just like this random decision that's not based upon any sort of hard and fast rule that they follow. Um, so it's not a very good trend following system. You don't go flat, you don't go short. Yeah, it just doesn't make any sense. I don't see the intellectual reason that compels me to want to combine a bunch of markets together. I don't do it in the commodities. I don't trade the commodity index. I don't trade the dollar index. I can trade them, because like Bruno said, you can trade it. You don't have to not. I know, but you kind of know going in that it makes literally no sense. It's a bastardization of our way of trading, in the sense that we there's a certain rightness and um, zen to applying a systematic approach to each market, um, long, short, flat, using that market's ATR at entry to size that position, not based upon a random cap weighting. And then we want to give up, and then which is going to produce this inherent quality that's inside every market, which is just serial correlation, this possibility, this hiding of this big outlier that's buried inside there that we want to get out of there eventually, hopefully. And why do we want to put all of these together? And why? There is one reason why that we trade the indices and CTAs in particular, um, because they exist. They're there. That's why we trade them. And the CTAs have made a pact with each other. Like, no group of traders and hedge funds want diversification and have more diversification than CTAs. All the currencies, commodities, bonds. We don't trade the Vanguard Bond World Index that includes all the bonds. No, we want multiple uh, options to in the commodities and the currencies and the interest rates. But we've made this pact with each other. Well, it stops right there, because it's too much darn work. It's too many choices to make. Um, and I and we've all agreed we'll just trade the indices because that's what we do. And it sort of fits in with this idea that smoothness counts, because that's what got me going on this. We don't want this smoothness. We want these crazy outliers, but it's, once again, it's harkening back to Sharpe, this other thing that corrupts the industry, which is we prize stability and lack of volatility and vol targeting, but we don't. We do, but we shouldn't.
Exactly,
Uh,
Jerry, and that's what compromises these absolute returns. So an index, it's the same argument we were saying before, in that if we theoretically had unlimited capital, would we trade the S&P 500? Well, no, we would trade 500 individual equities that are model selected, not what a committee has given us. So there's this convenience there for especially people with low capital, where they can get exposure to 500 equities, even though it's a cap weighted model that's given to them, where really there's only 10% or so of it that significantly influences the index. But it's this convenience factor, and really all we're doing is compromising our absolute returns by considering those instruments when, with a bit of hard work, with more capital, with greater levels of smaller bet size, with greater levels of diversification into uncorrelated equities that are our choice. There are reasons for why we are choosing those uncorrelated equities. We're searching for industries that are significantly different to each other. We're not deciding what a committee puts together, where the vast proportion of it is dominated by tech. So all of these things compromise absolute returns, which I think we should be railing against.
Yes, and I think that it's not my thoughts only. I have heard in one interview this, and I remember it, that commodities index, it's a very stupid idea, especially stupid idea to trade commodity index, because it's a basket of commodities, total uncorrelated basket of commodities. So it's very unpleasant for trader to trade this, because And if we are talking about stock market index, it's not okay to trade it also, but it's more correlated to each other. Stocks they are more have a more correlated uh, factors, but commodities it's the best sector maybe for us for trend followers, and to make it in an index and to make it a basket and trade it. It's we will have not this diversification benefit anymore after this.
Come on, Rich, you're getting too tough on the S&P. And yeah, if you can choose between trading 500 markets, with splitting our bets along all of them, versus one big market that's the S&P, definitely 500 markets will be better. All I'm saying is, if we can treat the S&P as a market of its own, I think there is merit here, because people trade the S&P on an individual basis. People make decisions based on the S&P level, not the underlying levels. I'm not saying that the S&P is better than any other individual markets, or that the S&P is better than trend following applied to 500 markets. Definitely not. It's for the simple reason that more markets mean more diversification. As simple as that. And another, go on, Richard, if you would like to
No,
add.
no. I was going to say, look, I am being hard on the S&P because I think we've got a bit of selection bias going here towards the S&P. Like, so if we're talking about index construction, why aren't we talking about Nikkei? Why aren't we talking about FTSE? Why aren't we talking about Spain? Why aren't we talking about the Brazilian index? If we seriously applied our philosophy on that basis, where we're simply trading a different market, and we truly were diversifying our bets towards these different equities using indices, we'll get a far more paltry return than just a pure investment in the US equities. So I think the question we're talking about is severely biased by our selection bias from the performance of US equities.
So here's a
Yeah.
question, and I hope it's taken in the right way. Has anyone ever tried to make their own 500 stock index using U.S. equities? Because it seems like it would outperform the S&P, and bam, you got a nice little hedge fund. Obviously, transaction costs are going to crush you, but S&P doesn't rebalance. You know, if you did it every 3 months, has this been done, Richard? Or I don't know.
I tell you what, if that was done, I'd be in like Flynn, because if there is a CTA committee that selected based on trend following requirements the constituents of a trend following index for equities, a whole class of them, yeah, I'd be in there like Flynn, because they're particularly aligned to our trading models. Well, you'd have to make sure they're aligned to our trading models, but that'd be a fantastic opportunity, I personally think, but that's not the case.
Let's make an ETF, man. Let's get it going.
And you wouldn't even have to trade all of them. I think if you traded the top 10, you would get pretty much 90% of the S&P movement. Microsoft, Amazon, Apple, Google. Maybe it used to be Netflix, but I think. And then so then here's the question: if the S&P is one market, so if you trade the S&P, you probably give it the same weight that you give a FTSE and DAX and CAC and Nikkei and the 20 some indices. But so if the S&P is this one market that gets that equal weighting, what what about if you traded the top 10 stocks from the S&P? Is that 10 markets, or is that still just one market? You see, I'm just trying to
10
trip.
markets.
I'm sorry?
10 markets.
Exactly. It's 10 markets, but it doesn't make any sense. It's this, except that you're going to get much better performance out of the 10. You're going to, intellectually, it's more robust and makes more sense to apply those signals to those 10 individual markets, parentheses, like you do in all the other markets you trade, in parentheses, and use those 10 markets ATR, and you're just doing what you always do, okay? However, then you throw the index in there and say that's one market, but no, it's 500 or it's zero or it's something. It's its own market. It's really squirrely. I think the S&P has its purpose. Like you said, that for low cost people who want unsafe exposure, long only exposure to these stocks, something they should not want, but they've been told that it's a good thing. It's the core. And look at the recent performance. Oh my gosh. If one of your children came to you and said, but hey, look at recent performance on anything else in life, you would say, whoa, whoa, whoa. Sit down. We have some talking to do. You don't base your next step on a few things that have happened recently in life.
I think that I totally agree with this because I think that even if we are talking about 10 very high correlated markets, and I think that it will be so in this situation, we have different signals. So, for example, if we have a flat period, non-performance period, drawdown period, even we have such a benefit of diversification that not all the trades will be if we will be in work. For example, if we trade only SP 500 and we have this trade and we have losing trade, and if we trade 10 markets from the SP 500, we probably will have only 4 signals in work, or maybe 5, and our 5 other signals will not be working, and will not lose this money. We will keep this money on our account. So it's a very great benefit of a diversification, not only hunting the outliers, but reducing the drawdown.
Perhaps one way of doing what Andy was doing, and I think getting at the point of what Richard is saying, is disentangling, one of the major flaws of the S&P, which is, non-equal weights. And so, use your approach, which is ATR, so harmonize everything, make sure it's equal weight in risk terms, not only in percentage terms or in dollar terms, but in risk, in ATR space. But also the other things that I kind of like about this idea is doing a sort of, a dual variance decomposition, up variance, a down variance, i.e., how much of the S&Ps, which are the winners in the S&P and which are and the stocks that are the losers, and try to explain, I don't know, 90% of the up move and 90% of the down move, and then perhaps wrap it into an ETF and trade it. That would be a nice little strategy, which of course I haven't tried, but it seems like a good way of fixing all the different problems that we've been talking about here.
My head's spinning, Bruno. You've got me thinking now.
Do you guys think that momentum indexes are an improvement over the S&P, given that there's no committee and the rules at least are not movable? Although I don't know how is the weighting scheme done.
Not sure. The only thing I'd say is that, look, we are masters in our world. We are masters of constructing our own index. We call that the portfolio. I don't like being told by a committee what portfolio I should trade, because I like my models to decide that. Now, with momentum indices, I'd say they're probably a lot better than these alternative indices that we have at our disposal, such as the S&P, NASDAQ, all of these different things. But yeah, look, I'm not. I'm certainly going down the line of let's treat all of our bets individually. Let's don't try and consolidate them for convenience into a method, because really, if we had this level of capital, the aim is build your capital. Take your small bet sizes. When we start compromising that, we start getting this mixture. We start getting this smooth return stream. We start finding that we're no longer a classic trend follower. We're now a different quasi form of trend follower that has these smooth returns. We find that whilst that might be appealing to our investors, whilst that might be something that people love smoothness, it's going away from our delivery of absolute returns over the long term. That's my only concern.
Yeah, the S&P has the rules, but they're not the same as our golden rules. I would never say that it's some kind of trend following. Far from it. It doesn't cut its losses. Simple as that. Not quick enough. Not as quick as our golden rules would say.
I think another thing that crept into the Twitter conversation around this is that I like to hear everyone's opinion on this too, because I think that it's not as a consistent discussion as some of the other topics we bring up, and that is that I think somebody mentioned this idea that stocks have a different personality, or they behave differently. Yeah, well, I've gone back, I've looked at these stocks, they act different than commodities. And this is a hot topic, and I think that I think looking back historically, maybe from a trend following point of view or not a trend following point of view, just by long only, uh, you will see obviously different characteristics in the markets and in groups, and yet we continue to say that the the markets all have this serial correlation characteristic, and they could all become an outlier at any point in time, and we should trade them all the same because any sort of seeming differences we've seen in history are not won't necessarily hold up, and we're just suffering from lack of a lot of enough data to make those type of inferences. There was a great chart that my buddy posted on Twitter, Mike Shell, and I think it was used car prices. And what was funny about that chart was that it was in a consolidation for 10 years or longer. And then all of a sudden, it's just been a tremendous skyrocket, in prices for used cars. I think it was used cars. And I just thought that was a great, amazing looking chart that you're just sitting around waiting, and there's nothing happening in this market. It's a waste of your time. It's the cocoa of stocks. We're sitting around. Although, look at that cocoa chart. I've been long, and I've been long for a while. I got bounced out of less than half my position, continuing to hold. I think it's making a breakout now. So here we go. Here comes cocoa. And so with cocoa or with these used cars, you wait and wait and nothing happens, and that has no predictive ability for what can happen and is happening when you get a hold of these trends. They're embedded, hiding inside of all the market data is this outlier potential. And yet there's a lot of analysis going on that says, oh, well, these markets are different based upon the past data, and we should maybe treat them different, which is a violation of so many levels of trend following, loose pants, and treating all markets the same in sample size. But I think that is it true that they're all the same, or we should treat them all the same, or should we take clues from some of the markets that they're obviously different?
I think that I'm sorry. I think that if we can make a system less complex and the same effectiveness would be the same, we must do it. So it's at least it will be easier to execute the system that is less complex. It's my point.
Gonna say I believe they are different, right? The markets are different. They have their own characteristics, but I think the measurement or the way to measure those differences, if you tailor those to each different market, then you don't have a consistency. So it's the lack of consistency that you will create there by obviously tailoring your methods to each individual market, and plus assuming that obviously we know and we can assume that the way it is right now will be the same as in the future. So rather than tailoring or changing the measurement for each different market, you create a standard by using the same method, same approach. So you approach them uniformly. So that's almost equating to using the same measuring stick, and by doing that, you're measuring the differences of those markets rather consistently. So even though obviously we agree that the markets are different, we need the same measuring stick, and that's by being consistent. And it's almost looking at it as different markets that you still apply the same rules to rather than tailoring to it, so that you can get the consistent results out of those.
Jeff, I think our process actually does a couple of things. The first thing is, I think we do recognise that individual markets have different market behaviours, but we are not after the individual characteristic behaviours of markets. Our process is actually excluding our consideration of markets that display these different behaviours by virtue of the fact that we are focusing our efforts towards these tail regions. So with our lookbacks and specifically with our normalisation using ATR, we are deliberately eliminating the individual characteristics of the market, or we are suppressing the noise associated with the linearity of the different market signature to only focus on the non-linear aspects of that market data. So it's a process of exclusion where we are not participating in those trade events that respond to a market condition or a predictable pattern or an oscillation. We are diluting that impact and only considering major price moves. So our lookbacks, our ATR normalization is confining us to this region where we are only focused on major directional price moves that we are assigning to, well, according to JPB, 90% are these endogenous moves. So we're not looking for a causal reason because we can't find or can't attribute a direct cause to these endogenous moves. But we know that they occur with significant material impact, and our process actually shapes it that we are only targeting those features of the market.
I think that people also are different, individual. Every person is individual, but we all eat food, wear clothes, drink water. So we have something in common. All people have. So are the markets. The markets. There are such factors that are common for all these markets according to natures of laws of nature, as I said before many times. And I want to say about this endogenous events. When I listened to this and about endogenous events from Rich, I was impressed very much, and I'm impressed very much really because this is a science very important maybe to our world, to finance. It's We understand how this works more deeply. That we have this. We don't need fundamentals. We don't need because there is no sense of these fundamentals because 90% of all the moves are from endogenous events, and I'm very thankful for this science that I get known this, and it's very interesting. And this changing the narrative of our trend following, that we're not like we simple. Yes, of course, a lot of people don't understand us why it's so simple. But I want to say, and I wanted to say this later, that I was speaking with a few people, I remember this, who don't know anything about trading, a little, and they said, it's not a very good idea to be a trader because you predict the markets. You traders, all the traders, they think so. All the traders predict the markets because of fundamental, because of global macros. But not all the things in life are predictable, and sooner or later you will not predict the market and you will lose your money. And I said, I don't predict the markets, I do something another. And people were interested, and they say, why and how can you trade, how can you have money in this field not predicting the market? Tell me, please. And I told, and for intellectual people, intelligent people, it sounds interesting. So maybe if we change the narrative, they say that it's a science, there is endogenous event. There is we not only by high, so it's all algorithm in this complex world, a lot of complex factors, and we use simple, like Richard said. It was one of the best what I have listened in the field of science. I like very much this narrative scientific approach, and so we use our simple method not because we are dumb, like Richard said, because it's a very good idea, because it works good, and we have a lot of evidence of this. Because when we use it, like I said a few minutes ago, and I'm saying what Richard said, that there are a lot of different factors. It's a complex system, and we use simple rules to be a winner in this system, and it works.
Just to be aware as well, serial correlation. Look, any speculator in the market needs serial correlation in the time series. If there was no serial correlation, each time interval would be independent to each other to produce this random price signal that no one would be able to develop any arbitrage from. So we are fortunate that all traders, all speculative traders, convergent traders and divergent traders require serial correlation to extract an edge from the market. However, serial correlation to a convergent trader, if you go back to the Hearst days, you'll find that the serial correlation is anti-correlated. In other words, a directional move up is followed by a directional move down. There is this oscillating pattern associated with that serially correlated behavior. That produces patterns. That's what's responsible for pattern recognition. That's what's responsible for mean reversion. It's all based on a principle of there's this equilibrium out there. We've got this anti-correlated serial correlation effect of a positive move followed by a down move, followed by a positive move, followed by an up move. That's what these other forms of trading technique capitalize on for their edge. The serial correlation trend followers are looking at, or any long vol strategy is looking at, is a unidirectional serial correlation where a high is followed by a further high. There isn't this anti-correlated serial correlation. It's actually a positively correlated serial correlation. It clusters across the time series, so it waxes and wanes. It is not persistent throughout that entire signature. That is what's creating these outlier moves, these volatility expansions. So just be aware that we all need serial correlation, whether we're a trend follower or not.
I think this findings from JP that we've been talking the last weeks, they're definitely interesting. But I wonder if we are stretching the rope too much here. From what I understood from the podcast, I admit I haven't read the paper, but from what I understood from the podcast, he tries to disentangle events between endogenous and exogenous, and he measures what's exogenous from the news feed on Bloomberg, and everything else is dubbed endogenous. But when we look at the long-term trends, I find difficult to agree with the idea that it's one single piece of news that could unfold a long-term trend. And from what I remember from the podcast, he's studying very short moves within the day. And now, when we look at, for example, what we are seeing in the bonds or in the rates, do you guys call this endogenous or exogenous? Is this, from your perspective, endogenous or exogenous? What we're looking at the grains, endogenous. My question boils down to, what's your definition of endogenous and exogenous? Because I think it's different from what I understand, or from what I've learned in then again, in economics school.
Bruno, you'll have to listen to some or read some of his other papers, but this stuff he talked about on Top Traders, this endogenous exogenous events, was based on his research of this 1 minute data, as he said. Now, what he did, it was pretty exhaustive in his process, because whilst he did look at the Bloomberg news, he was looking at all forms of news, and he was basically very broad in ensuring that there was some recognised news that was available to the public feed that created these exogenous features. And what he noted was that the signals that arrive from either an exogenous source or an endogenous source are significantly different. What he noticed is that the signals from an exogenous source, we had very low volatility. The news event came, there was this explosion in volatility, and the important thing is the decay rate. The decay rate after that news event was quite quick. When we talk about quite quick, we're talking on the minute time frame, we're talking, weeks to dissipate. So it's still, when it consolidates up into a higher time frames, it's still quite a significant impact. But the important thing was the endogenous events. The endogenous events had a signal that was more likened to earthquake events. So if you can imagine an earthquake event, it's not a single event. It's a periodic episode of these tectonic movements. The wave pattern set up. You get this major move followed by quiescence. Then you get another major move followed by quiescence. And these endogenous events, he attributed the incredibly long decay time, and we're talking years in some instances, to decay. He attributed that to the fact that the endogenous source, the source of that event, was fairly well unknown to the market. They couldn't pin down the exact causal reason for that move. So if you imagine a price series like cocoa, or you imagine a price series like soybeans or coffee, we notice that these have these significant, what we visually can see is these exploding price moves, but it isn't necessarily related to a particular harvest. It isn't necessarily related to something we can pin down to a causal reason. And he attributes this level of uncertainty by participants on what is the cause of that endogenous event to its enduring decay length. In other words, the uncertainty is what gives it this enduring nature, because nobody really knows what it was caused by. I think that's a way to interpret the difference between the two styles of events.
So I'm thinking here. So what you call endogenous, almost an admission of ignorance.
Yes,
I don't know one
arising.
particular cause.
An event arising from within the
It's
system itself. It's not an event arising from news that is received by the system. In other words, there is some factor occurring in the market, and this is where Jerry was, we could talk about phase shifts and things like that, but it's where these price moves, or these major price moves, are associated with things that might have a very small critical seed that explode. You've got to bring into the notion of tipping points, things, the butterfly effect, all of those different things create this level of uncertainty in the causal reasons for that endogenous event. And because there is this uncertainty by the participant, they don't know how to handle it, which is why that event or that volatility continues and in fits and starts, because it might arise again, and they just don't know how to deal with it.
Yeah, it's as if you have a keg full of gunpowder that's from different sources, and then you have perhaps one single event that triggers it all, but it's not necessarily that one event the cause of it, but actually all that stored gunpowder you had before.
So if you talk about
is that correct?
yeah, if you talk about we understand when we boil water, when we heat up water, its mechanics is liquid mechanics until it gets to 100 degrees. And suddenly something sets off a different mechanics. We get this internal rearrangement of the state of those participants or the state of those agents in that system to suddenly do a completely different behavior that is now expressed by gaseous behavior as opposed to liquid behavior. And we find that there's not just two phases of water. There's actually 5 solid state phases. There's gas, there's liquid, there's ice, there's plasma, and then there's this thing called Bose-Einstein condensate. So there's 5 levels of different phase state, which is a totally different behavior in each phase state that exists in the simple atomic table. When you look at participants in financial systems, we have this behavior shifts. It's not explanatory. We can't model it. We can use agent-based models to see how these phase state changes occur, but it isn't something that we can assign a statistical predictable value to, because participants, by their definition, are sort of they're fundamentally uncertain in their level of knowledge and their nature of behaviour. So when you comprise all of these as an aggregate together, really strange things happen at certain market time frames, which we can't assign a causal event to.
Could we say that we could
Yeah.
measure it, but it's more in a lagging indicator way, as in like after the fact?
Yeah, hindsight would probably
Yeah.
come up with a narrative, but I think even statistically, I don't think we've got the models yet that can accurately predict these different phase state mechanics.
Okay.
Yeah, and that's the thing. It's as if to reach that tipping point, you have to have a lot of preconditions, but you never know where you're at. I mean, it's as if you have a loading bar, and you never know where you're at this loading bar, right?
Yeah, this is a very interesting question with these interest rates. And I was thinking, like, is it possible that a market starts off as endogenous when we sell the breakout last year in the interest rates, and now it feels like it's more exogenous? So can the markets go through these shifts, which could say to us, hey, be more wary now, because this trend may be ending because it's so much news and it's so obvious now with inflation and 7.5%. And so, obviously, when I first heard about this, you've got this news, this volatility, this parabolic up move. This must be one of the 10% because we're getting somewhere very quickly, and then it maybe has a tendency to crash. So, can we have a separate entry? I mean, a separate exit for these uh, markets, these trends that have these characteristics? And then Richard cautioned here, was saying, well, not so fast. And so I think that's the real intriguing part, is once we see these characteristics, news, volatility, parabolic up move, uh, is this the 10%? And the 10%, the 90-10 is comforting as well, because it reaffirms that if in fact that is the case, then 90% of the trends, these outliers, are going to be last months and months or maybe years. That's good from a people who have chosen a long-term trend following point of view.
Using Richard's example on with water, I think it's we for an outlier to show up. I understand that we have to have a lot of preconditions for that. Price goes way off, and and each breakout we see, it's like little bubbles forming inside the water, when it's about to boil or about to become steam. I think that's the thing. We don't know how hot the water is. We can only see the bubbles, and our breakout systems. It's a way to identify these bubbles.
Yeah, the key thing is it's a rearrangement of the internal network, that the interrelationships that occur in that system, and this rearrangement is not a one-to-one relationship; it's a one-to-many relationship. So, when you reconfigure such relationships, it's complex and it creates these non-linear transitions because of the complexity, the breaking down of prior relationships, etc. And that's what causes this cascading effect to occur.
I wonder, Richard, if you've tried to look for these phase shifts and transitions by looking at different metrics than price. And what I mean by that, looked through the lens of just price. I quite like the analogy that Bruno just brought up. These things seem to be, every breakout is a little bubble inside a pot of water that's about to go on to boil. But maybe if we investigate other dimensions, we would see that, for example, the strength of the flame underlying this pot of water is picking up, and therefore we are getting closer and closer to a phase shift and a phase transition. So the question is, because I really don't know. I mean, this is not how I look at things. But how are you trying? Like, have you tried to hunt for these transitions and phase shifts by looking at different metrics? One thing I'm thinking of is just looking, for example, how capital moves across the different regions and across the different asset classes. Maybe that could be a way to further pick up clues on this transition.
Look, it's a hard game, Bruno. I think the closest I've got, back in physics, yep, I used to look at these things. I used to look at, where the temperature of water suddenly reaches a threshold, and we get this phase shift transition occurring, and the temperature actually doesn't increase until that entire phase shift has occurred, and then the temperature can increase as in gaseous form. These are things dealing with fairly simple, complex systems where you're dealing with constituent elements that are fairly homogeneous and uniform. But when we're dealing with participants in this market, I just know from the behaviour of myself, let alone the behaviour of others here, how different we all are. And when you start putting those collectives together, I personally don't think there is any definitive guide to how to detect outliers. I think I'm much safer just assuming that they occur and having a model that deals with that they do occur, as opposed to any attempt to try and predict it. Mind you, there might be, I'm hoping that in the course of time there are research labs devoted to this exercise, because it could amount to something, but it's well beyond me.
Yeah, finding them, all you have to do is just trade long term, and I'm the world's best at finding them. I have more open trade profit than and anybody could just copy me. These long term systems, they build up a lot of open trade profit. Now, knowing when to get out and maximize that open trade profit, that's what I see as really problematic. And but as long as you don't do anything, and at some point in time in all of these markets, you're going to have the biggest trade on. And of course, I've often said I probably will have the biggest drawdown on that trade as well, because I got to that level of profit by not doing anything, not getting out. And so, and I've seen a couple of these mega multi-hundred to 500 ATR moves. And so I'm like, well, maybe this is another one. But you only get those moves, in your portfolio uh, because you don't liquidate and just hold on.
I guess being long term catches different phase shifts, and maybe thinking out loud, if you're being long term and that, well, the you're catching the asymmetry, you're almost waving through the different phases, and sometimes it goes as far as, well, the phase shifts makes the price move so far ahead that it's almost not going back to where it was in the beginning when you entered. So, but yeah, that's me just thinking out loud.
Jerry, don't want to get too down the secret sauce here, but does time enters your considerations when choosing systems? From my research, when I go to these really long term systems, they do have the best trades, but they get too long to to cash in, in for lacking a better word. But I was wondering if time is a dimension you evaluate your systems.
Return, the compounded return, but not um, time in the market. I don't. A lot of these long-term systems too. They'll produce a nice trade. I hesitate to call it an outlier. Um, that other systems will generate losses. So some of those nice trades, they're not great, but they're better than the losses. Like the wheat complex is a pretty good example. It's been very choppy. It hasn't gone very far, but I never got out. And so shorter term systems would have just generated a lot of losses. So compared to that, I don't mind being very patient and trying to help the market a bit to turn into this outlier. There could be this next phase in wheat where it starts to look like soybeans and corn, and then that's the big outlier trade. Uh, Now, I helped it by uh, staying in that for the first year and a half where it really didn't do very much. And also, I kept my ATR, which could be tremendously low compared, to a trade at the next up phase in these suites. The ATRs are much higher now. So I've kind of fertilized this and helped this trade out a bit by not being impatient, and that sort of drives me. And that is my philosophy is, I only got this philosophy after doing the back test, and the back test saying this system makes the most amount of money, um, per risk, the stop loss risk, um, and that is if you know I don't want to do a trade unless I'm compelled to do it. Don't want to take a small profit. I mean, I will take a small profit by following my system, but these systems are not designed to kind of take small profits, and I want to sit there with lots of volatility and lots of open trade equity that has potential to go away because that's how you get the big ones. But these long term systems, they make the most compounded annual return. Or if they didn't, I wouldn't trade them.
I see. You're in a way you're dodging the whipsaw, and well, I think that would be really good for me. Last year, I was slashed on the wheat market and also cocoa. Oh my God, what a terrible market to be a short term trend follower.
Jerry, can I ask you why you guys at the beginning started with a short term trade system when you were turtles and you began?
Well, it was just their strategy of of trading very large, and trying to make 200% a year, um, and protect the capital. And it was a much different game. Um, and so it was just their choice to do that. Um, I think, obviously now I don't think those systems work very well. And when I've said before, like the definition of an outlier with those shorter term systems was 20 ATRs. That's the outlier. Oh yeah, and I was delaying because I lost my train of thought. But it's kind of like, even though they talked a lot about news in the markets and fading the news, and sort of in around a similar way talking about endogenous and exogenous, because the exits were the 20-day low, you kind of captured both. If it was an exogenous move, then you definitely got it if it was going to be short lived, and if it was a long term move, a 20-day exit or a 40-day exit, that would keep you in there. You may have to get bounced out and get back in. But to a large degree, I think the size of the outlier is dependent upon your exit and how long term you are. And I think that it's different for everyone. um, all my systems make the same amount of money, but the average trade is smaller on the shorter term systems than the longer term systems. It's almost like you have to run your back test and look at the trades and just define it as 5%. My 5%, my biggest, the 5% of the trades that are the biggest, that's the outlier, whatever that average is. And so for someone else, it'll be different. But yeah, it was just their desire to want to trade really large and make 200% and preserve the capital, not go out of business.
I remember also you said that Richard Dennis said that that kind of system got better with his own personality, right?
I
Can you
don't.
say that again, Andre?
I think I remember that Richard Dennis said that those short-term trading systems got better with his own personality, his own personality.
I don't know. I don't remember that. I remember saying that his way of trading was influenced by his personality. Like, say, more so than mine. Like, I don't really um, try to trade. Oh, there was a good tweet out this week that said something like, don't find a trade that suits your personality. Find a trade that suits someone else's personality and sell it to them, or buy it from them. And that's exactly right. That's and I sort of made a joke that that's exactly what we did like a year ago when we went short these short-term interest rates. My personality was to sell it to someone who wanted to buy the 100-day low. So go for it. And so um, I don't really want my personality to influence my system rules. I want the back test to influence my system rules. But sometimes I would ask questions and say, why did we choose an ATR of two? I mean, a stop loss of two ATRs. And they would say, oh, yeah, that's suboptimal, but that's our personality. And I was like, no, that's weird, because I didn't want to be um, subject to my failed human instincts.
Well done, Jerry.
My nightmare would be for one of those guys to be listening to all this crap that I'm saying, and because people remember things differently. And I remember going to a turtle reunion one time, and we were talking about, this is 10 or 15 years ago in Chicago, and we were talking about this one trade, and someone held on to a trade a lot longer than the rules indicated. Although they were very flexible at us coming up with our own kind of rules. They kind of wanted us to, like, just quit copying everything we say word for word, figure things out and let us know what you think we should test or whatever. So anyway, someone held onto a trade, did not get out at the 20-day low or the 40-day low, and they came over. Someone came over and said, "We need an explanation from everyone. Write it. Send us a written explanation as to what you think about this idea of holding trades longer, being longer term." And so, I think this person made money on this trade, And so I recanted that story, and then to the person who held on to the trade longer than he was supposed to, and he told me that never happened. He said that whole thing never happened. And I was like, all right. I mean, I was there.
Yeah, I always ask questions about that change from short term to long term, because being that trend followers are so even and parsimonious about their trade rules, that was a huge change on your side, guys. And I always ask myself, how did you reach to such a big and important decision?
I was interested in hearing from Richard about this phase shift. I remember in the podcast with Niels, you said we need to talk differently, and we need to. And then I think you uh, introduced this idea of phase shift. Although I think I had heard it before when you spoke. But what does it mean to you? Well, why and where did you come up with this? And then why do you think it's necessary for trend followers to sort of use a different phrase? Like, I want to make sure I understand what's behind this phrase versus just it sounding a bit different.
Look, the bottom line, Jerry, is that it comes from a principle that systems exhibit discrete characteristics, not continuous characteristics. So it's based on the principle that um, rather than treating the market behavior as something that is consistent, predictable, resolvable, um, it introduces this notion that there are particular discrete points in the market where changes suddenly take a totally different form. There's a transition from one form of behavior to another. And this is what I regard as our edge, because I regard that as the failure point of predictive models. So I don't believe that predictive models span these different regimes. I believe that they focus on a particular behavior that is associated with a single regime. So this is where I think, and so in that regime, that single regime where this behavior is fairly consistent, we can assign a more statistical basis to that regime, where we can identify an equilibrium of that regime. We can identify, levels of excursion in terms of standard deviation away from those means. Notions such as predictability, etc., revolve around this principle that there is a standard market behavior in a particular regime. But when we introduce a thing called a phase shift, it produces this barrier or this threshold that creates a major transition from one form of behavior to another. And I think that it's actually the transition event which is what we are targeting. We're not targeting the behavior in each distinct regime. We're targeting the transitions between regimes. So if you could imagine that the bulk characteristics of a single phase are associated with fairly homogeneously distributed variables in that regime that create this character of that regime. When you get a phase shift, you get a total reshuffling of any former or prior relationship that exists in that system to create a totally different behavior. So it's actually the difference between the prior regime and the next regime that we're focusing on. We're not focusing on the next regime, we're focusing on the transition between regimes, which creates this sort of enduring exotic behavior that, because it's a transition, it can't be predicted, because we need to know both states to be able to solve how the transition occurs between those states. I hope that makes it a bit clearer.
Yes, very good. It makes me think about possibly how important it is to have a fixed universe of markets. There can be some pluses and additions and subtractions from your group for obvious reasons, but by and large, you want to continue to trade that British pound, not get rid of it because it hasn't performed well, because you've been waiting and you've been spending money on these other trades in the British pound and nothing has happened. And you need to continue to do that because eventually you'll be paid back. And so, this whole idea of having more of a fixed portfolio allows you to kind of eventually um, get your fair share. what's coming due you, which is you patiently waiting for many years for this outlier trade.
That's exactly right, Jerry, because these transitions are what we refer to as one-off events. There is no sample size to these transitions. They are unique, exotic transitions between phases. So unlike our predictive cousins that are looking for a predictable pattern, we need to target these one-off features. So we need a totally different process to target something that's a one-off major feature as opposed to a predictable condition. So you never know. Any liquid market has the propensity to display this transition. We never know when it occurs. It's probably going to be a once-off or a one in a few, but it occurs quite frequently in the context of markets because the dynamics of that market is a moving feast. We get injections from central bankers into the market. It's an open system. It's not a closed system. We get all of these inputs coming in that are continuously reshaping the dynamics of the participants in that behavior. And it's just an exotic moving feast that sometimes displays predictable behavior, other times is caught in transitions to a new type of predictable behavior. So we've got to, when we talk about the success of trend followers, it's our ability to survive over multiple regimes. And these different regimes, where we survive is in these transitions between these regimes that pay for all of that waiting, all of that patience, that all of the predictive traders are getting from those particular regimes. We're not harvesting that. We're harvesting these transition points, which is why we get these spectacular returns.
I don't know if you remember, but you tweeted something, or someone tweeted something this week about rules, and I thought about how important rules are, and how I've always thought that they were important, of course, and following these rules is the heart of what we do. But I was so taken by this tweet, and I wanted to write something about rules, and I thought I had this very profound thing to say about rules, and I couldn't think of what to write. And so all I could write was, rules are the reason we make money, or that's how we make money, by following these rules, which was like not that profound, but it was almost like I wanted to put a marker in Twitter and say, I'll come back to this later. And I got to thinking, like, what did I learn about the importance of rules in 1983? And I was having a hard time. I think it's more mathy than I thought it was, or that I've been thinking about. It's kind of like we want to follow these rules, but it really ensures that we maybe could get close to the back test. And I think when you don't, what happens with our math of our systems if we're inconsistently applying our rules of entry and exit?
Exactly, Jerry. that comment you made was like, I was thinking of what you were talking with of Niels, which is why I went into this big thing on sample size, because you're so spot on, and you sort of topped up the end of that tweet fest with this classic line, which really sort of summed it up eloquently. And the basic fact is that any trader, or any, even science finds this, the best we can do is develop models. And the models basically express how we interpret that market or that system to behave. It doesn't necessarily mean that it is actually how that system behaves. The best we can ever do is have a model, which is a theory or an assumption, and embedded in that model are rules. And so that therefore leads to the statement that there are some rules that are better than others. In other words, those rules with sample size that are embedded in those models with sample size, they are better rules than inferior rules that can't stand the test of time. And so it really brings into focus the importance of sample size. And this is where it comes back to your discussion with Niels, where you don't make decisions based on a handful of trades. That defies the whole principle of rules. Why you've got these solid rules in your system? Our rules have been decided by our empirical process, where we have shaped those rules in response to the market conditions over an incredibly large sample size. So they are very important rules, but they are rules of a model. And it doesn't necessarily mean we can explain the market's behavior, but those rules, like a cockroach surviving in an environment it doesn't understand, those rules, or the cockroach is a model that has been very successful surviving this hostile environment. It doesn't understand the system, but it has got these rules baked in through evolution, through sample size, that makes it incredibly robust. We adopt the same evolutionary principle by our testing method and our process, where we develop these incredibly robust rules using sample size. And so that's detach our ability to make decisions on the fly. Why would you do that when you've got these rules that have stood the test of time through a process of evolution that has survived for so long?
I like this approach very much, and if we look at different fields, we can see how successful is to be rule-based. For example, to drive a car, you certainly can maybe drive a car without any rules, but it will be a car accident in maybe few minutes to few, maybe 1 hour, and so in all these fields, we can see that how important to be rule based, and that sample size, in fact, that it's a history, and the sample size, our backtest, a good backtest, it's a history of success. And of course, the history is not always what Jerry says, and I agree with this, that the past is not often a good guide to the future. Not always the best guide to the future. I think it's often, but not always. So we must understand the process, how it works, and so we have a logic, we have common sense, and we think about this process, understand how it works, and then we have a backtest. We do backtest at least 5,000 samples, and we have a history of success, maybe a theoretical history of success, and begin to apply this to a market, to our trading activity. It becomes our strategy, and if we are disciplined, we are successful. And also, I liked idea of Mark Dzerzhinsky that, in fact, it came from a lot of this from the science came from military guys, when it is a battle, people must have rules and must be very disciplined in following these rules, because if they are discretionary, in this stressful situation, in fact, it's very low probability that these people will be successful.
I just thought about something, and that goes back to the beginning. You can have a mouse trap, right? And you could catch a mouse, and let's say the next mouse that you catch is a small mouse. So you reduce, or you make a smaller mouse trap, but then there's a bigger mouse that comes up, and now you need to make it bigger, a bigger mouse trap, but that might not work for the smaller one. So so as to speak, is you can almost tailor those rules to each mouse that you catch, but you could also, through evolutionary process, find in almost a trap that maybe doesn't catch all of them but catches most of them. And obviously based over time and with experience, we've kind of created our university, or the best mousetrap that we can think of right now. And unless there are new things that we find out that maybe can improve that mousetrap, it's better to have one that catches most of the mouses, not every one of them, but not tailored to one of them, so that we can catch the bigger bunch of them almost, rather than just tailoring it to a smaller mouse and then a bigger mouse, and you just continue going on.
I love it, Jeff. First it was spiders, now it's mice. And I noticed Jerry took down the spider web from his Twitter heading, so I think it's going to be mouse traps now.
By the way, I want to tell you about spiders a little. Maybe 10 years ago, I was renting an apartment where it were spiders, big spiders, tarantulas there on the balcony, and I want to say that it's very interesting. I watched them. It's very interesting insect. It's very powerful insect because the spider can sit on one place for maybe 2 or 3 days on one point for 2 or 3 days or maybe more. And if he is frightened or if he is hunting, he is very fast. He is very fast and he is very strong. And he has his net. And I mentioned that spiders always have something to eat.
That's I love the spiders, and I like how we're introducing these new ideas and animals and concepts. And spider was up there for a while, but I just love the non-normal trade distribution graph. It's from the old days, and it's so beautiful. And it is a group of trades. It's not returns, and it does show the outliers, and it's what we're all about. And I even tried to incorporate that into the Chesapeake logo. And so I think there's, no matter what gets put up there, my hockey team when they win, the football team when they win, Richards, Spider, they're all going to eventually lose out to the outlier, the chart that shows the trades and those fat tails and those outliers. I tried to introduce musical chairs, you know, a few weeks ago when I was on the
I
podcast.
heard that.
I thought that was pretty good. Yeah, it didn't really take off, and I'm not even sure if it's correct or not. Musical chairs, but it was it was something interesting and good. Just to get back to the rule thing, there is something about the math of the system that falls apart if you don't apply these rules consistently. And I remember, and then for most of us, traders, I think that as much as we want to come up and find a better approach and a multiple entry and exit approach, but who knows? Maybe we'll be a bit too short term or a bit too long term. Um, but I just remember back during the training class, it was it was just hammered into our heads that um, being consistent and following a set of rules that maybe weren't as good as someone else's rules was so powerful and way more powerful than agonizing over having the perfect entry and exit parameters and signals. Was much more important to take the best that you have, the best that you can do as it relates to the number of markets. It may not be 150 or 200. The systems, they may not be optimal. You may not have the ability to do a big back test, as if that really matters. But just the one thing that everyone has in their power, which is the hardest thing to do, is just to be brutally consistent all the time and follow these methods. And I just think that it's very few people that have ever done that. Um, I think that the knowledge that I have on systems, I could have always had that knowledge, and I could have always traded these particular systems, and they have performed so well over time that, and I don't see other track records, certainly not even my own, that looks very similar to these simple trend following systems. So there's a lot of energy and a lot of money and time poured into back testing. But when I look at some of the optimal methods, um, that obviously, yes, they do pay attention to being very robust and having a single exit and a trailing stop and a stop loss. I don't see a lot of people out there who, oh, that looks very familiar to XYZ CTA. So I think that's the dirty secret, is that we we have a lot of capability on talking about things and coming up with great back tests, but actually sticking with it and not and doing those trades in the future is something that, for whatever reason, not a lot of people have done.
I think that it's very important here to be I like this word very much. It's very, very important to all of us, what Jerry just told us. It's very important. And I think we must train ourselves in this to be consistent, to be disciplined, and to be focused. Because I think we must be. I train myself, for example, at least to be focused on the markets and to think about the markets, about the system. By the way, backtest, listening, systematic investor, it helps to be focused. Like it is said in the preview of systematic investors, that keeps you to be focused. Yes, it's really so. And yesterday I have heard a story about famous billionaire Andrew Carnegie, and when he was asked what is the secret of your success, he said, I can be focused for 10 minutes on one thing, and that people began to laugh and this, and they said it's not sound serious. And he said, okay, do this, focus on something for 10 minutes. And they understood that it's a problem to be fully focused on something on 10 minutes. So we must, I think so, at least, that for me personally, that I must focus I focus on markets, so on the trading process of the rules. And when I'm thinking about the rules, about what must I do, and not about my emotions, not about some maybe different. I understand that there are a lot of different approaches, but I have chosen my way. So be focused. Here is my point.
I was wondering, I think y'all probably, I think I know the answer to this question, but I thought I'd ask it anyway when it comes to rules. Let's say you're following a new, like Moderna, when you follow Moderna, you get in on the 100-day high, and the 100-day high is an all-time high. So the rule says, oh, I got to wait 50 days, 150-day high to get in again. Is it appropriate to have an alternate rule which says, oh, I can get in when it's 5 ATR up after 20 days rather than wait for 50 days? I just wondered if anybody had thoughts on that.
So you're basically saying you don't have enough data. One of your parameters might be 150, but you don't have 150 days. I mean, yeah, I mean, I don't think it's a. I would just wing it. You know, if you were hell bent on trading Moderna or any sort of market like that that doesn't have quite enough data. I've done it both ways. I've waited, for my longest term system to be able to be entered, have enough data to have a legitimate signal. Then also I've done the opposite. I've said, okay, I'm just going to put this trade on and at the same entry point, and hopefully over time, I'll be able to exit with my 4 different exits. But I don't agonize over those type of decisions. Yeah, I don't think it really. Right now, I'm just trying to find enough, just to find stocks that look like I should add that have enough data. But I've done it both ways.
Oh, got it. Thank you.
By the way, I like very much this idea of finding new markets if you're a trend follower, because first of all, it's a sample size, and first of all, it's not a sample size. I think first of all, it's an opportunity to be more diversified, and of course, for the backtest, we can see more samples and so on, so forth, and I like it, and for example, instead of adding new systems or something like that, it's if I have money for this on my account, it will be better to use this money, uh, not breaking risk management rules, of course, to add a new market. Don't add a mid-reversion system or something like that, but add just a new market, and this new market will diversify more my portfolio, and it will be better.
Hi, it's interesting. I want to add something to in terms of following the system. It's interesting. I think I listened to one of the market wizards in person. Actually, I wrote it down. That's exactly what he said. System is the boring thing. Nothing is interesting. That's where you make the most of the money. So would you like to add anything? Thank you.
I think, the classic trend following systems, it's just such a struggle for most people to sort of buy into that sort of idea, like just as hard as not paying attention to sharp or volatility so much. So I think you get into a discussion with people like us, it's just a given. We think this is the best thing on how to organize our trading life and our investing life, but then I think the vast majority of people don't sort of see it that way. So it's something I've been doing for so long that it's just like a given, and I don't even think about why I do it anymore. So that's why I brought up this whole idea: why am I following these rules? And I had started to think, I should be able to write something very articulate about how important it is. Um, but it just seems like one of those things that's so obvious to some of us that we just gloss over it. But it is very important. And I think when I first started, um, what we had to do, January 1984, was we had to write down the reason we did the trade. What was the rule? What were the rules you were following, and keep a log. And I think that's pretty important. It didn't last that long, but what a great situation if I would have kept doing that for all these years, because I would be able to go back and see, okay, um, also write down, when you don't follow the rule and do the trades that you shouldn't have done, or don't do the trades you should have done. And then you could go back and say, wow, look at all that evidence of all the money that I did not make um, by not following these rules that I had sworn I was going to. I remember going in for this interview, and I remember reading a lot about trend and systems before I got there. And I just remember thinking, like, oh, one of the things you have to really talk about is how dedicated I will be to following the rules. Oh, I mean, no one's going to be able to follow the rules like I will be able to follow them. And of course, none of that was true. And I had a struggle to follow the rules. Um, but it is so important. And I think some people are very set up to do that. And then, but I think one of the things that's happened over the years is people come up with bad rules. They say, well, these rules, one exit, that's way too restrictive. I'm going to give back too much profit. I'm not going to be able to handle granted, the system makes the most amount of money, and it will make, I firmly believe it will make a lot of money if I follow the rules, but I cannot handle this particular month, day, this particular trade, and what could possibly happen. So I must get out of some of this trade and override my one exit rule that over time will yield the most profit, but maybe not this month, this day, this particular trade. And I think that's how you get more rules involved in your system, and your sample size plummets and your robustness plummets, but you're following the rules. So we just have this ability to screw it up and to try to convince ourselves and others. And let's get into this little holy huddle and tell each other, yes, vol targeting is good. Yes, pay attention to sharp. Yes, trade indices, don't trade stocks. If we tell each other this enough, we can convince each other and do not stray from this orthodoxy, because if you stray and you have a tendency to do better, you'll put us all in a bad light. And I think this is one of the bad things that happened to CTAs over the years. There was too much complicity on what was the right and the wrong things to do.
I want to say that for me personally, system is one of the most trading systems, one of the most interesting things in the world, and they shows how, for me, how world organized. I think about myself, about how I interact with this world, and so on. It's very interesting if we think about it, if we discover it. And I have done a lot of research. I listen interesting podcasts. I have interesting discussions. So it's very interesting to be a trader. It's you're free. You're free in your thoughts, maybe even. I like it. It's one of the most favorite things for me in the world. And so I understand the point that your trading process must not be exciting. It means that you must not have emotions. When you put your trade, you must handle all this pressure, but it's very interesting to be a such person who can do this. And I agree with the Jerry, and I think all trader, all professionals understand this, how interesting it is. But if it must not be exciting the process of daily day-to-day process. It's exciting if when you think about this, about maybe I do back then when I wanted something excited, to be to feel exciting, I did a back test. I did a back test, and it's very interesting. But of course, we must have good risk management rules. We must not put ourselves in the situation when we think if we be billionaires in a few months, or we will have no money at all, and we will sell our apartment, our car, or something like this. In this point, that it must not be exciting. It must be risk management is the first thing about what we must think. And Jerry and Niels said about this. Niels said that in down capital, first of all, people think about the risk, and after that about the other things. So put the risk first. I think it means only this, but not that the trading process is not interesting.
Yeah, it reminds me what Larry Hyde said when his cousin asked him, "Oh my gosh, it's such a boring job you've been doing." And I think his reply say, I'm not looking for excitement. I'm here to make money."
Yeah, the first thing you got to do, Lulu, is reduce your bet size to a point where you seriously don't care about a loss. So what this means is that as opposed to worrying about every trade, if you can reduce your bet size to a point where the losses are insignificant emotionally to you, you find that you might be looking at your screens maybe once every 2 weeks and 3 weeks, find that there is very little change in your equity balance. And so can you imagine how boring it would be to look at all of the individual trades that occurred during that period of time? You detach yourself using a systematic process. You totally detach yourself from being involved in any individual trade, because your rules and your entire process has taught you that that is not the way to view this game. So through that detachment process, a systematic process, and the fact that you seriously don't want to spend your entire life looking at the screen, and there's far better things to do, like engage in Twitter conversations and a Clubhouse and all of these things, and hassle Jerry and all of those sort of things. They're much more fun things to do than to be worried about what your individual trades are doing. Then one morning, you wake up and you find that your balance has materially shifted in the positive. They're the surprises you get. That's when trading isn't boring, because you wake up one morning and you think, my God, look what that system has delivered me. But it's not you that's delivered it, it's your system that's delivered it. It's your rules-based system. So you put all your faith in your system and you detach yourself emotionally from the mechanics of the trading activity. That's the way I tend to view the way I play this game.
That's so true. Thank you.
Okay, great, guys. We're at our 2 hour mark. We did it again. We wish everybody have a happy, good weekend. And thanks for everybody participating. Thank you, Rich, for recording all of this. And I look forward to listening to the podcast this weekend and getting some more good stuff off Twitter. And we'll do it again next week, next Friday, same time. So,
Who's on this weekend on Top Traders?
I don't remember. Maybe. Well, I know that Alan, the newest member, Alan Dunn, who came from a CTA fund of funds, is starting his own, has started his own podcast. Under the Top Traders Unplugged umbrella, the Allocator series or something like that. So I expect to see the Richard Brennan um, special series start up as well, where you can be your own host and
That'll be the day.
this deadweight Niels, who weighs us down. No, just joking. But yeah, so Niels is really expanding with his blog and all the fun stuff that he's doing with the Volatility podcast as well, and now it's the Allocator podcast, I believe. And so I don't expect to have mine either. I mean, I'm very happy with the Clubhouse of way of doing things. It's more relaxed for me, and I have encouraged Niels though to go the route of Joe Rogan because I don't know too much about him other than when I checked him out one time on Spotify, he had a video as well as the podcast. So I think live video has just got to be our next thing. I mean, um, it'd be so much fun to see all the faces that Rob makes, and then I want to see
That'll
him
mean that
imitating me.
he'll have to put his hairpiece back on if he went visual.
I want to see Rob imitating me. I asked Niels, I listened to these podcasts on YouTube very carefully. I looked at the transcript, and then there was that one part a few weeks ago where Rob was imitating me. Yeah, and he was, this American accent, and so then I was joking that I would take lessons on how to have a British accent so I could imitate Rob. But there was this one part where I could not understand what he was saying, and so I asked Niels. I said, and also, was Rob accusing me of having a Texas accent? And Neil said, yes, he did. I'm like, that's what I thought he said. I couldn't figure it out 100%, but a Texas accent. So, I love Texas, but come on, I don't have a Texas accent. So anybody he wants to make fun of, not only are they American accents, it's a Texas person. So he immediately accuses me. So then I asked Niels, I'm like, okay, on the down low here, I need like an area in England where they're looked down upon based upon their accent, and so I can accuse Rob of being from there. And so he gave me a town, and I have it in my back
Call him
pocket.
a Liverpudlian.
I think it was Essex, which I have no idea what that means. But so, anyways, it would be so much fun to see for people to be able to see these live battles between all of us and how much fun we're having, and especially when people dress up in Christmas costumes. That was fun as well. Okay, enough's enough, everybody. It's been fun. Have a good weekend. See you next week.
Thank you. Have a great weekend. Thank
Thanks,
you.
everyone. Bye.